Welcome. Today, we're diving into the world of guarantors, a term you might have heard when dealing with loans, rentals, or financial agreements. But what exactly does it mean? In simple terms, a guarantor is someone who agrees to take responsibility for another person's debt or obligations if that person fails to meet them. This role is crucial in many financial transactions, providing an extra layer of security for lenders or landlords. Throughout this video, we'll break down what a guarantor does, why they're important, and what risks and responsibilities are involved. Let's get started by understanding the basic definition. A guarantor is an individual or entity that promises to pay a debt or fulfill an obligation if the original party fails to do so. This is a common requirement in situations where the lender or landlord wants extra assurance that they will not lose money. For example, if you're renting an apartment and don't have a strong credit history, the landlord might ask for a guarantor. The guarantor's promise is legally binding, meaning they are on the hook if you default. This arrangement helps build trust between the parties involved. Guarantors are most commonly seen in financial transactions, like loans, rental agreements, and sometimes even in business contracts. For instance, when a student applies for a loan but lacks a credit history, a parent might act as a guarantor. Similarly, young professionals renting their first apartment may need a guarantor if their income doesn't meet the landlord's requirements. In business, a company might need a guarantor for a large contract. These scenarios all share a common thread. The guarantor provides security and confidence to the other party. Lenders and landlords often require guarantors to reduce their risk. If the primary borrower or tenant fails to pay, the guarantor steps in to cover the debt or obligation. This is especially important when the original party has a limited or poor credit history, unstable income, or other risk factors. By having a guarantor, the lender or landlord feels more secure in extending credit or offering a lease. This practice helps more people access loans and housing, even if they don't meet all the standard requirements on their own. When someone agrees to be a guarantor, they sign a legal document often called a guarantee agreement. This document outlines their responsibilities and the conditions under which they must pay. If the primary party defaults, the lender or landlord can demand payment from the guarantor. The process is straightforward. The guarantor is notified, and they are legally required to fulfill the obligation. It's important to note that being a guarantor is not just a formality. It's a serious commitment with real financial consequences. There are different types of guarantors, depending on the situation. A personal guarantor is usually an individual, like a family member or friend, who guarantees a loan or lease. A corporate guarantor, on the other hand, is a business entity that guarantees obligations for another company. Sometimes, government agencies can act as guarantors in specific programs. Each type of guarantor has unique responsibilities and risks, but the core idea remains the same, providing a safety net for the lender or landlord. A personal guarantor is most often a family member or close friend who trusts the borrower and is willing to take on the risk. For example, parents frequently act as guarantors for their children's student loans or first rental agreements. The personal relationship adds a layer of trust, but it also means that if the borrower defaults, the guarantor's finances and credit can be affected. It's a big responsibility and should not be taken lightly. A corporate guarantor is a business entity that guarantees the obligations of another company. This is common in business loans or large contracts, where the lender wants assurance that the debt will be paid even if the primary company cannot. The corporate guarantor's financial strength is evaluated before the agreement is made. If the primary company defaults, the corporate guarantor must step in and fulfill the obligations, which can include paying debts or completing contractual duties. It's important to distinguish between a guarantor and a cosigner. While both provide security for lenders, a cosigner is equally responsible for the debt from the start, whereas a guarantor only becomes responsible if the primary borrower defaults. This difference affects how lenders pursue repayment and how credit is impacted. Understanding this distinction can help you make informed decisions when entering financial agreements. When someone becomes a guarantor, they take on significant legal responsibilities. The guarantee agreement is a binding contract, and failing to fulfill it can lead to lawsuits, wage garnishment, or damage to the guarantor's credit score. It's essential to read and understand all terms before signing. Legal advice is often recommended to ensure the guarantor knows exactly what they're agreeing to and what risks are involved. Being a guarantor is not without risks. If the primary borrower defaults, the guarantor must pay the debt, which can be a significant financial burden. This can affect the guarantor's ability to borrow money in the future, as lenders may see them as a higher risk. Additionally, if the guarantor cannot pay, their assets could be seized or their wages garnished. It's crucial to consider these risks before agreeing to be a guarantor. If you act as a guarantor and the primary borrower defaults, your credit score can take a hit. Even if you make the payments, the additional debt can affect your debt-to-income ratio, making it harder to qualify for loans or credit cards in the future. Lenders may also view you as a higher risk, which can lead to higher interest rates or denied applications. Always consider the potential impact on your credit before agreeing to be a guarantor. Not everyone can be a guarantor. Lenders and landlords typically require guarantors to have a strong credit history, stable income, and sometimes even significant assets. This ensures that the guarantor can actually fulfill the obligation if needed. Some agreements may also require the guarantor to be a resident of the same country or region. Meeting these requirements is essential before you can be accepted as a guarantor. The process of becoming a guarantor usually involves a thorough application. Lenders or landlords will check your credit report, verify your income, and sometimes require documentation of your assets. You may also need to provide identification and proof of residence. Once approved, you'll sign a guarantee agreement that outlines your responsibilities. It's important to review all documents carefully and ask questions if anything is unclear. The guarantor agreement is a legal document that spells out the guarantor's obligations. It details when and how the guarantor must pay, what happens if the primary borrower defaults, and any limits on the guarantor's liability. Some agreements are unlimited, meaning the guarantor is responsible for the full amount, while others are limited to a specific sum or time period. Understanding the terms of the agreement is crucial before signing. There are two main types of guarantees: unlimited and limited. An unlimited guarantee means the guarantor is responsible for the entire debt, no matter how large it becomes. A limited guarantee, on the other hand, restricts the guarantor's liability to a specific amount or time frame. It's important to know which type you're agreeing to, as this affects your potential risk and financial exposure. The duration of a guarantee can vary. Some guarantees last for the entire term of a loan or lease, while others may expire after a certain period or when a specific condition is met. It's essential to understand how long your obligation as a guarantor will last, as this affects your financial planning and risk exposure. Always check the agreement for details about the duration. A guarantor can sometimes be released from their obligation if certain conditions are met. For example, if the primary borrower consistently makes payments for a set period, the lender may agree to release the guarantor. Alternatively, refinancing or paying off the debt can also end the guarantee. It's important to know the process for release and ensure it's documented in the agreement. Guarantors have certain rights, including the right to be informed if the primary borrower defaults and the right to seek repayment from the borrower if they have to pay the debt. In some cases, guarantors can negotiate the terms of the agreement or request to be released under specific conditions. Understanding your rights as a guarantor can help protect you from unexpected liabilities. The main obligation of a guarantor is to pay the debt or fulfill the obligation if the primary party defaults. This can include making loan payments, covering rent, or fulfilling other contractual duties. The guarantor must act promptly when notified of a default, as delays can lead to additional legal or financial consequences. Always be clear about your obligations before agreeing to be a guarantor. The risks of being a guarantor are significant. If the primary borrower defaults, you could be responsible for large sums of money. Your credit score may suffer, and you could face legal action if you can't pay. In some cases, relationships can be strained or damaged due to the financial pressure. It's essential to weigh these risks carefully before agreeing to be a guarantor. For borrowers, having a guarantor can open doors to loans, rentals, or contracts that might otherwise be out of reach. Lenders and landlords are more likely to approve applications when a guarantor is involved, as it reduces their risk. This can be especially helpful for young people, newcomers, or those with limited credit history. The guarantor's support can make a big difference in achieving financial goals. In rental agreements, a guarantor is often required when the tenant has insufficient income or credit history. The guarantor agrees to pay the rent if the tenant cannot. This gives landlords peace of mind and allows tenants to secure housing they might not otherwise qualify for. The process is similar to loans, with the guarantor signing a legal agreement and undergoing a credit check. In loan agreements, a guarantor provides assurance to the lender that the loan will be repaid. If the borrower misses payments, the guarantor must step in and cover the debt. This is common for student loans, personal loans, and sometimes mortgages. The guarantor's credit and finances are evaluated before approval, and the agreement is legally binding. In business contracts, a guarantor, often a parent company or financial institution, guarantees the obligations of another business. This is common in large transactions or when the primary business is new or has limited credit history. The guarantor's involvement reassures the other party that the contract will be fulfilled, even if the primary business encounters financial trouble. Guarantors are also used in international business deals, where trust and enforcement can be more complicated. A bank or financial institution may act as a guarantor to ensure payment or performance across borders. This adds a layer of security and helps facilitate global trade. The terms are usually detailed in international guarantee agreements, which are recognized by courts in multiple countries. Another important distinction is between a guarantor and an indemnitor. While both provide financial backing, an indemnitor promises to compensate for any loss or damage, not just pay a debt. The obligations of an indemnitor can be broader and may include covering legal costs or other damages. Understanding the difference can help you choose the right arrangement for your needs. Student loans often require a guarantor, especially for young borrowers with limited credit history. Parents or guardians typically fill this role, agreeing to repay the loan if the student cannot. This allows students to access education funding they might not otherwise qualify for. The guarantor's credit and finances are carefully reviewed before approval. In some cases, mortgage lenders require a guarantor, especially for first-time homebuyers or those with weak credit. The guarantor agrees to make mortgage payments if the borrower defaults. This can help buyers secure a home loan, but it also puts the guarantor's finances and credit at risk. The agreement is legally binding and should be considered carefully. Car loans may also require a guarantor if the borrower has limited credit or income. The guarantor promises to make payments if the borrower cannot. This helps more people qualify for car loans, but the guarantor must be prepared to take on the financial responsibility if needed. As always, the agreement is legally binding. Small business loans often require a guarantor, especially for startups or businesses with limited credit history. The guarantor, often the business owner or a third party, agrees to repay the loan if the business cannot. This provides lenders with extra security and helps businesses access funding to grow and operate. Some credit card issuers require a guarantor for applicants with no or poor credit history. The guarantor agrees to pay any outstanding balance if the cardholder defaults. This allows more people to access credit, but the guarantor must be aware of the potential risks and obligations involved. Utility companies may require a guarantor if the customer has a poor payment history or no credit. The guarantor promises to pay any unpaid bills, ensuring the utility company gets paid. This arrangement helps customers access essential services, but the guarantor must be prepared to cover costs if necessary. Mobile phone providers sometimes require a guarantor for customers with limited or poor credit. The guarantor agrees to pay the bill if the customer defaults. This allows more people to get phone contracts, but the guarantor must be aware of the financial responsibility involved. In some insurance policies, a guarantor may be required to ensure premium payments are made. If the policyholder fails to pay, the guarantor must cover the premium. This provides the insurer with extra security and helps policyholders maintain coverage. The guarantor's financial situation is usually reviewed before approval. When leasing expensive equipment, lessors may require a guarantor to ensure payments are made. The guarantor agrees to pay if the lessee defaults, providing the lessor with confidence to enter the agreement. This is common in industries like construction or technology, where equipment costs are high. Hospitals or medical providers may require a guarantor for patients with uncertain financial situations. The guarantor promises to pay any unpaid medical bills, ensuring the provider receives payment. This arrangement helps patients access care, but the guarantor must be prepared for the financial responsibility. In immigration cases, a guarantor, often called a sponsor, may be required to ensure the immigrant has financial support. The sponsor agrees to provide financial assistance if needed, helping the immigrant meet residency or visa requirements. This is a serious commitment, as the sponsor may be legally required to support the immigrant for several years. In some legal cases, a guarantor may be required to ensure child support payments are made. The guarantor agrees to pay if the responsible party defaults. This provides extra security for the child's well-being, but the guarantor must be prepared for the financial and legal responsibilities involved. Court bonds, such as bail bonds, may require a guarantor to ensure the defendant appears in court or fulfills legal obligations. The guarantor promises to pay the bond if the defendant fails to comply. This adds a layer of security for the court and helps defendants secure release while awaiting trial. Some exclusive clubs or organizations require a guarantor for new members. The guarantor vouches for the applicant's character and agrees to cover any unpaid dues or damages. This helps maintain the club's standards and financial stability, but the guarantor must be aware of their obligations. Some subscription services, especially those with high fees or long-term commitments, may require a guarantor. The guarantor agrees to pay if the subscriber defaults, ensuring the service provider receives payment. This arrangement helps more people access premium services, but the guarantor must be prepared for the financial responsibility. For expensive travel bookings, such as group tours or long-term stays, a guarantor may be required. The guarantor promises to pay if the traveler cancels or fails to pay. This provides travel companies with security and allows more people to book trips. But the guarantor must be aware of the potential financial risk. Event planners may require a guarantor for large or expensive events. The guarantor agrees to pay if the client cancels or fails to pay for services. This helps event planners manage risk and ensures vendors are paid, but the guarantor must be prepared for the financial responsibility involved. To wrap up, a guarantor plays a vital role in many financial and legal agreements, providing security and confidence to lenders, landlords, and service providers. While being a guarantor can help others access opportunities, it comes with significant responsibilities and risks. Always read agreements carefully, understand your obligations, and consider seeking legal advice before agreeing to be a guarantor. By being informed, you can make the best decision for your financial future.